Today we would be covering our chapter on annuities, which is chapter number 12 of the module CFP 2, Insurance and Risk Management. Let's see what is an annuity. What do we mean by annuity? Annuity, as the name indicates, annuity basically has been derived from the word annual. So annuity is, financial terms, annuity is an interest. It's paid on a principal, but interest paid on regular intervals. These regular intervals should not exceed, one interval should not exceed 1 year. So this is the meaning of annuity. That means if there is a principal amount of, say, rupees X, and if the interest is to be paid on this X amount, so this interest can be paid on monthly basis, it can be paid on quarterly basis, every 2 months, every 4 months, it can be paid on half-yearly basis, or it can be paid on yearly basis. Even if a principal amount is invested with a financial institution, and if that financial institution is paying the interest every year, it could be for 10 years, it could be for 20 years, it could be for 5 years. So this interest, payment of regular interest, is known as an annuity. Whereas we know that in the market place, when we buy let's say an NSC, National Saving Certificate, we buy a fixed deposit FDR from a bank. So what do they do? An NSC, for example, an NSC, it gives us a lump sum amount after 6 years. For example, if I invest rupees 10,000 today, so today NSC, the post office is giving return at the rate of 8% per annum. So by the end of 6 years, this amount would be 16,070 rupees. So here in this case, they are not giving interest every year, they are giving a lump interest along with the principal at the end of 6 years. So in this case, the interest amount will not be known as an annuity. Similarly, an FDR may be for 6 months, it could be for 1 year also. But if 10,000 invested today, after 1 year, they are giving 10,000 something, XXX, let's say, something. After including interest, again it's not an annuity because they have given me interest along with my principal. But if only the interest amount is being paid, that is known as an annuity. Now this annuity, this word is has been borrowed by the insurance companies and by other financial institutions in order to pay regular amount to a person, regular income to a person. So generally we have begun to call it as an annuity. Basically, so now let's see how this annuity is being adopted by the insurance company. Annuity can be basically classified into an immediate annuity, and second is deferred annuity. What is an immediate annuity? Let's take an example of MIS scheme of post offices in India. MIS scheme is monthly income scheme or monthly income plan offered by post offices in India. What happens in the plan offered by the post office? For example, if a person invests 1 lakh rupees in the post office under their MIS plan, the return which they are giving is again at the rate of, but what this is a scheme of say 6 years. What happens in this scheme? They will give the interest to investor every month. For example, 1 lakh is, let's say, 8,000 rupees per annum. So per month this is 12 6 are 72, around 667 rupees per month. So for the next 6 years, the customer will continue to get 667 rupees per month. What this 667 denotes, this is an annuity and this is an immediate annuity. Because the moment the customer has deposited his 1 lakh rupees, from the next month, his annuity has started. So this is an example of immediate annuity. If a person has got a lump sum amount, 5 lakh, 10 lakh. Of course, in this scheme, there is a maximum limit that one cannot invest more than a particular amount. But another financial institution is offering annuities. So if one has a lump sum amount, one can buy annuity from any financial institution. But let's take the case of deferred annuity. What happens if a person doesn't have a lump sum amount, but he wants to get some regular amount, some regular interest after some time? For example, after retirement. For example, in the old age, when a person becomes old, when a person is no longer in active employment, when a person is not able to work even in his own profession because of the weakened body, his weakened faculties. So what happens in this case? In that case, a person may get annuities after a certain period of time. For example, I have certain money, I have some lump sum of money which I invest over here, and I invest with a investment company. So that this investment company will grow this my money over a period of time, and at this point of time, it could be my retirement age, it could be any age. I will call it as a vesting age, because retirement age technically would be known only if I am in active employment. But here I can call it as vesting age. So the financial company or the investment company will give me annuity at this point of time, although I have invested my lump sum money over here. So this period would be known as the deferment period. This deferment period could be 5 years, it could vary 5 years to 20 years, maybe 30 years, maybe 35 years, depending on scheme to scheme, from one investment company to another investment company. Now what happens with insurance companies? Insurance companies have also started giving these annuities. So what they say, if you have a lump sum amount, you can pay it here, which will be known as a single premium. But if you don't have this lump sum amount to pay at this point of time, okay, you can pay regular premiums every year, again, like in a life insurance plan. So these regular premiums again could be on yearly basis, it could be on quarterly basis, it could be on monthly basis. So therefore, over a period of time, which is known as your deferment period, client pays the premiums, and when he reaches the age chosen by him, when he reaches his or her vesting age, by this time this amount is being invested, and by this time it would have grown into a bigger fund at this point of time. So this fund then would be known as the corpus. So this corpus, in layman's language, we can say this is a kitty which has grown into a big amount. So out of this corpus, now the investment company or the insurer company will pay the returns on this corpus. Basically, those returns are basically interest on this corpus. Now, how did they grow this fund? It depends on plan to plan. Again, we had studied the concept of endowment plans, we had studied the concept of unit linked plans. Again, there could be simple plans where the money is invested in traditional modes of investments like government funds, government securities. Then the fund would grow in a defined fashion. But if this money is being invested in equities, in mutual funds, then there is a likelihood that this fund will grow into a big corpus. It could be otherwise also, it could be the reverse also, or because it depends on the market condition, it depends on the volatility of the market. So therefore the risk in that case, in case of unit linked annuity plan, the risk would be of the customer, of the client. So whatever happens, the fund, when it grows to a certain amount, the annuities are given out of this corpus. So this annuity is known as pensions in the commercial market, because for the common man to understand, we call that this is your pension plan, or this is for your retirement. You can plan your retirement according to your situation, according to your circumstances, according to your life cycle stage. Now there is an interesting fact about these annuities as well as life insurance. It's a common proverb in the finance field that annuities are a reverse of life insurance. Well, we know what is life insurance contract. A life insurance contract, as we know, it's intended to meet the needs of survivors or beneficiaries when the life assured dies within the term of the policy, and beneficiaries receive a sum of money. Basically, it's in a lump sum amount. But what happens in an annuity plan? In annuity plan, basically the amount could be invested in a lump sum, or amount could be invested in installments, but the benefits definitely are not given in lump sum. Benefits are given in installments or in the form of annuities. Those annuities could be monthly annuities, those could be quarterly annuities, those could be half yearly, or at the most those annuities can be annual annuities because of the name. So therefore, if we see the basic difference between annuities and life insurance, basic thing annuity is that in annuities periodic payments are given from the corpus fund, whereas in a life insurance, in case the life assured dies, benefit mostly is given in a lump sum. Now, life insurance covers the risk of dying at a premature age, or in other words, we say dying too young. Life insurance is not meant for those people who have completed their obligations towards their family. After a certain age, it's said that there is no need of life insurance for a person. Now, the need of the person is to cover his own risk, that is living too long. Living too long is also a risk. If a person has nothing to bank upon, he has no sustenance, means of sustenance, then it's a risk. Even living too long will become burden for this person. Now, another interesting fact about these annuities, there are various annuity plans, but generally we see in the government jobs or in when a person is employed with a company, what happens with pension? The moment the person dies, the pension stops. So in a similar fashion, insurance companies have also designed various plans of annuities in such a fashion that whenever the client, now we can call this client as an annuitant who receives an annuity, whenever this, as soon as the annuitant dies, the annuity also stops. Whereas what happens in life insurance? When the person dies, we give the sum assured to the person. So again, in this manner, they are opposite to each other. Then in life insurance, there is a need for underwriting. We have to assess the risk, whether we can give insurance to this person or not. So insurers always fear that there should not be any adverse selection. We should not select the wrong person on the basis of health, on the basis of financial status, on the basis of moral hazards. Whereas, because we are not in a pure annuity plan, if we are talking about a pure annuity plan, there is no such fear, there is no such apprehension if a person dies. Doesn't matter, because we are just investing his money and we would give them the annuities on the corpus. So there is no chance of adverse selection. So it's we say that it's based on the process of self-selection. Now let's see what are the various types of annuities which are being offered by the insurers in India and also in other countries. The basic type of annuity is, or sometimes we also call it life annuity. This is very simple plan. This is just like any other pension plan which is given by an employer to an employee. After the vesting age, out of the corpus, the annuities are given. The insurers give a guarantee that they would continue to pay the annuity till the life of the person. But as soon as the person dies, the annuity will stop in this case. So if a person had chosen his vesting age as 60 years, and if he continues to live till 90 years, the insurers would also continue to give him annuity for this 30 years. But what happens if this another person, he had also chosen his vesting age at 60 years, he died by the time he reached 65 years. So insurer in this case would give annuity, they are guaranteeing for the whole life, but now the person has died, so the annuity will stop. But what happens to the corpus fund? There is one plan where the corpus fund will not be returned to the family or to the beneficiaries. So this is one plan where the risk of the annuitant is also involved. There is another extension of this plan which we can say that annuity for life with return of purchase price. Now what is this purchase price? We had seen that there is a fund called corpus. This corpus is the fund which is grown at the time of vesting age. This complete fund is known as the corpus. Now, what happens if the annuitant wants some part of it? He wants to build his house, he wants for some other expenses like marriage expenses and other expenses. Now, the government of our country have allowed that a person can take 1/3 of this fund. 1/3 of this fund can be withdrawn, which is known as which would be known as the commutation of the fund, or this is known as the commuted value. But he cannot withdraw more than 1/3 of this corpus. He has to take an annuity for the remaining 2/3 of the funds. Now this 1/3 of the fund which he commutes would be non-taxable in the hands of the client. Whereas the annuity which he or she will receive out of this remaining fund, that would be taxable. It would be a taxable income. If it is taxable according to his returns, it would be taxed. It may not, it depends on his income. But that would constitute a taxable income. Now, this 2/3 price, in case he has commuted 1/3 value, this 2/3 amount would be known as the purchase price, which is a common terminology. In case nothing has been commuted, the whole corpus would be known as corpus is equal to the purchase price. So as the insurers are giving the annuity, sometimes annuities is just plain interest, sometimes the annuity may also involve some portion of the principal amount. Because since they have to maintain a uniform annuity, sometimes the interest rates may fall down. according to economic condition, then they may have to include some kind of principal amount. So at times it may happen that after a certain period, now the corpus amount, the remaining amount is less. So whatever is the amount, it is known as purchase price. So his purchase price would be lower. So another is with return of purchase. Whatever purchase price is left, at that point of time, it will be returned. If a person dies earlier, the purchase price will be more. If a person has a wait, say for 30 years, purchase price will be very small. Whatever, it may not be, purchase price is if any. If anything is remaining in that point. So that is second type of plan. Then there is third type of important plan, which is known as annuity certain. Now basically in this plan, there is a fixed period for which the annuity is given. This fixed period may be, let's say it's 15 years. So that means if a person has opted for a vesting age of 60 years, in any case the annuity would be given for the next 15 years. So by the time he is 75 years, it will automatically stop at this point of time. Even if he were to live for longer, the annuity will stop because insurers have guaranteed him for 15 years. Now what happens if the person dies over here or here, somewhere in between? Then also the insurer has guaranteed to pay the annuity, then it would be paid to the next beneficiary of this person. In any case, they have to divide this corpus amount along with the interest and all in 15 years. So at the end of this, there will be no purchase price because they have included that purchase price also along with the interest part. Another fourth version of this is annuity certain, again with return of purchase price. Here, whatever is left out of this purchase price, they would return. Definitely, it's very obvious the interest rate of the annuity would be smaller in this case because they have to maintain some kind of purchase price. But in this case, they know they have to divide the whole of fund in 15 years. So this could be annuity certain, could be for 10 years, 15 years, 20 years. Generally, it can be up at the most up to 20 years. Generally, this is the market conditions. But it can be up to 25 years also. There is another fifth version of this, which we know, which is also very popular, which is annuity certain and life thereafter. Basically, it's a combination of the first type and the third type, annuity certain and life thereafter. For example, if a person has opted an annuity certain period of say 10 years. Now a person has chosen his vesting age as say 50 years. So for the next 10 years, this is age. For next 10 years, his annuity is assured. Whether he were to die within this period or not, the annuity would be given. But what happens if the person is still surviving at this age? Then it will be converted into a whole annuity for life plan. Then the annuities would be given by the insurer till the person is alive. But if the person dies by the time he reaches this annuity certain period, the annuity will stop. It won't be given thereafter. So this is another version of this plan. Then there is another version which is known as a joint life annuity. Well, this joint life annuity, this is for a person, say A. The annuity would be given for this to this person. Annuity for life would be given to this person A. On the death of this person, the annuity would be given to the surviving spouse. B is the surviving spouse. Then annuities would be given throughout life to the surviving spouse. And after the death of B, then annuity stops. There can be another version also, although it's not very popular, joint life annuity with return of purchase price thereafter. That means annuity would be given to first person, thereafter to the surviving spouse, and thereafter any purchase price, if any, if left over, would be given to the nominee. So there could be different versions, and it depends on the investment portion, the deferment period, how the investment is done, so as to build the kitty. Let's talk about another important concept, which is known as IRA, which is Individual Retirement Account. Most of the Indians are not aware of this terminology because this is more important in the international context, and it is being adopted by many developing countries now. And there is a big talk and big debate about this in our country also, because one bill called Pension Fund Regulatory Bill is in vogue in our country, which is about to be passed by the Parliament of India, and after that probably this concept will come in India also. But let's talk about this IRA in US context. Basically, IRA, individual retirement account, it's a trust or a custodial account which is set up for the exclusive benefit of the account holder or his or her beneficiary. The account holder may not necessarily be an employee of a company. Government may take care of his pension benefits, so therefore they may make mandatory for the citizens of the country to set up their accounts so that there can be a regular contribution by that individual member, so that a fund can be developed by the time this person retires, and out of that fund the annuities or the so-called pensions can be given to him till he or she is alive. So in this case, basically the state is taking care of the pension benefits. This kind of model is adopted in USA, in Canada, in other countries also, because there a person, even in UK also, there a person doesn't have to worry about his pension account. The state also is part and parcel of this kind of arrangement. There are various kinds of IRAs currently in vogue in USA. One is called the traditional IRA. Second is called Roth IRA, named after a scientist, behavioral scientist. Third is SAP IRA, simple IRA, and self-directed IRA. Traditional IRA, this account, it allows employees. Mainly, we are considering employees because most of the people in those countries are employees of one organization or the other, and otherwise it's also for self-employed people. Whatever earnings have been made out of those investments, they doesn't have any tax impact. But withdrawals at retirement, they do have an impact. They are taxed as income. And distributions from a traditional IRA are taxed as ordinary income, except for any non-deductible IRA contributions which are received tax-free. Similarly, in Roth IRA, because there is a difference of taxation in all these schemes, and sometimes choice is also given to the employee or to the citizen to choose one kind of contribution to the other. For example, in Roth IRA, annual contributions are not tax deductible, and whereas the investment income which gets accumulated, it's tax free. It's just opposite to the traditional IRA. Similarly, there is a SCP SAP IRA. Here, the only difference is that the investment is allowed in a traditional IRA. Instead of a pension fund account, it's in the company's name. Similarly, there are simple IRA and self-directed IRA. Self-directed IRA, in which the account holder also has a say in the investment of his funds. He can also suggest that his funds should be invested in. There can be various ways of funding. It could be either through cash or cash equivalents, means it could be either through existing bank deposits, existing investments, especially for central government employees. And 3 institutions have been earmarked to take care of their pension funds, which is more or less similar to this IRA concept. Those 3 institutions which have been earmarked very recently are Life Insurance Corporation of India, State Bank of India, and Unit Trust of India. These 3 institutions have been earmarked that they will maintain the accounts of the central government. In the coming time, we are hopeful that this annuity market or the pension market will bloom in this, and people would like to avail the retirement and annuity benefits out of these schemes. Thank you, participants.